Okay, so imagine this. A busy street, it's hot, you're in Hyderabad,
Right.
and there's this 5-year-old girl, Ria. She sees what she wants, a chocolate bar. Just a simple 10 rupee chocolate bar.
The perfect target.
Exactly. Now, in the old story, the one from maybe just a decade ago, her mom looks in her purse.
And all she has is a big note. A 500.
A 500 rupee note. The shopkeeper just sighs, shakes his head. He doesn't have 490 rupees in change.
Of course not. And the transaction just collapses.
It collapses. You get frustration, maybe some tears, all because of friction.
That's the word for it. The economy of small amounts was just defined by friction.
But today, in the story we're diving into, it's completely different. Ria gets her chocolate instantly.
Her mother just pulls out her phone.
Taps an icon, scans a little QR code taped to the counter, and hits send 10 rupees.
And then you hear that sound.
That satisfying little ping.
That's it.
And that sound, that one simple ping, represents something enormous. We're talking 185.8 billion transactions just last fiscal year.
It's instantaneous, it's secure, and this is the crucial part. It's free for that merchant.
Okay, so let's unpack that. Our mission today is to figure out how India built this system, the Unified Payments Interface, and turned this tiny payment into a global financial model.
And that really is the core insight for you, the listener, to grasp. UPI is not just another app on your phone.
No.
It is a foundational model. It's infrastructure. India made this huge strategic bet to treat payments as a public utility.
Like roads or electricity.
Exactly like roads. It had to be for everyone, and it absolutely could not be some kind of premium service.
That single distinction, utility versus a premium service, that changes the entire business model, doesn't it?
Completely.
So before we get into the big corporate savings and the global strategy, let's just lay out the plumbing. What are the key ingredients that make this whole thing work?
Right, let's get the language clear. The terms are pretty simple, but the why behind them is what really matters. So at the very top, you have UPI itself.
The Unified Payments Interface.
And you can think of it as a common digital road, a rule book that forces all the banks to talk to each other.
Yeah.
Instantly.
And that common road enables the single most important feature, which is interoperability.
Yes.
We've all been there, right? Wallet A can't send money to Wallet B. UPI just erased that problem.
It did. Interoperability just means no walls. Any app, Google Pay, PhonePe, your local bank's app, doesn't matter.
Right.
Can talk to any bank, which can pay any merchant.
Right.
The user never even has to think about it.
And for that user, the entry barrier has to be super low. That's the VPA, the virtual payment address.
Yeah, that simplifies everything. It takes a complex 14-digit bank account number and turns it into something simple.
Like an email address.
Yeah.
Ravi Adupi.
Exactly. It makes your phone number your financial identity.
But the engine driving all of this is the technology. Real-time settlement.
That's the magic. When Ria's mom sends that 10 rupees, it doesn't just show up on a screen. The actual money moves. It's in under 5 seconds. It's debited from her account and credited to the merchant's bank ledger. Immediately.
Let's pause on that because that's so different from how cards work. Card networks still use batch processing. Why is real-time so much better than the T+1 or T+2 the merchant normally waits?
It's the difference between now and later. With a card, the transaction is authorized instantly, sure, but the money itself sits in a clearinghouse for a day or two.
That's float.
That's float. It's money you're owed, but you can't use. UPI skips that entire clearinghouse step. The money moves end to end right now.
That speed is one thing, but the most radical idea here, the thing that guaranteed adoption by the smallest shops, has to be zero MDR.
The merchant discount rate.
Zero.
This is the revolutionary piece of the puzzle. MDR is the fee merchants always pay to accept digital money. For corporate credit card, that could be 1.5%, maybe 2% of the sale.
Right.
With UPI, by government mandate, the merchant pays zero.
And that's such a powerful idea. For a tiny shop owner, that 1.5% might not sound like a lot.
No, but it is.
But if your profit margin on a cup of chai is only 5%, that fee is eating up a third of your earnings.
Precisely. That cost was the biggest barrier stopping cash-only businesses from going digital. By making MDR zero, the government basically said adoption is more important than profit.
So any incentive to stay cash only, it just vanished.
It vanished. Okay, so that explains how it works. But let's get to the why. Why did this succeed on such a massive scale, hitting 640 million transactions a day, when so many other digital wallets have just hit a wall?
It wasn't an accident. You're saying there was this perfect storm, an alignment of factors.
The 7-step alignment. It's actually fascinating. You needed policy, technology, and behavior to all click into place at the same time.
What were they?
Well, the first three were the foundation. One, the explosion in smartphone penetration. Suddenly you have hundreds of millions of people with a computer in their pocket.
Okay.
Two, mass bank account creation. Programs like Yandan brought over 430 million unbanked people into the system.
So you have the device and now you have the account.
And third, you link that account to a digital ID, Aadhaar. So you have a reliable mobile number as identity.
The foundation is set. You have a massive verified customer base. Then what?
Then you build the rails. Step 4 is the UPI infrastructure itself, built by the NPCI. Step 5, the powerful zero MDR incentive we just talked about.
Right, remove the cost barrier.
And then step 6 and 7 are what really set it apart. An open app ecosystem, let everyone compete, and forced interoperability. All 7 had to happen at once.
Okay, let's talk about the architect here. The National Payments Corporation of India, or NPCI. It sounds like a stuffy government body.
It does, but they made maybe the single most important decision in modern fintech. They're the nonprofit referee. They were set up by the central bank and other banks.
And that nonprofit status is key, right?
It's everything. It means there's no pressure to maximize revenue. Their goal is inclusion and building national infrastructure, not hitting quarterly profit targets.
But hold on, if they built these incredible payment rails that handle billions of transactions, why didn't they just build their own app and monetize it? That sounds like leaving a huge amount of money on the table.
And that was the masterstroke. It goes back to that utility philosophy. The NPCI deliberately chose not to build an app.
Really?
They built the neutral pipes, the electricity grid. They knew if they left the user experience to the market, giants like Google and PhonePe would pour in millions to compete on building the best, slickest interface.
So they built the road and, like everyone else, built the cars.
Exactly. The lesson is be the utility, be the electricity company. The market will invent the toasters and air conditioners. Everybody wins, but the infrastructure remains essential and neutral.
Which is the polar opposite of the walled garden approach we've seen elsewhere.
Right. When payments are a proprietary business, walls go up, fees go up, and adoption slows down. When it's public infrastructure, inclusion comes first. And that's why India is now doing almost half of all global real-time payments.
So for you, the learner who needs to grasp the real-world utility here, the impact on a company's balance sheet is where it gets really interesting. This isn't just about convenience.
Not at all. It's about solving hard financial problems. It's about liquidity and reconciliation. Let's look at 3 quick stories.
Okay.
First, the retail CFO's nightmare. Before UPI, imagine a mid-sized retail chain. They're taking money from 8 different wallets, 3 card systems, plus cash.
What a mess. That sounds like an accounting disaster.
It was a disaster. Their team spent 6 hours every single day just trying to reconcile all of that.
6 hours of labor costs just fighting friction.
Exactly. With UPI, they get one consolidated file, the money's in the bank, instantly. That saved them over 1,300 hours a year, which came out to about 33 lakh rupees in savings, not to mention eliminating all the money that used to be trapped in float.
Okay, that's a huge operational win. What about liquidity? Let's talk about the treasury head.
Right, the person managing working capital. So a big manufacturer was dealing with thousands of distributors, paying them with checks.
So T+2, T+3 waiting times?
At least. Which meant at any given time, maybe 50 lakh to a crore of their money was just stuck in the system, waiting to clear.
And because of that delay, they have to borrow money to cover their own costs.
Expensive short-term money at around 8% interest, just because their own collections are slow.
That's crazy.
By switching their distributors to UPI, that 50 lakh daily float was just gone. It was available immediately. The annual savings on borrowing costs alone was nearly 1.5 crore rupees.
And it shortened their whole working capital cycle.
We dropped it from 45 days down to 38. For a treasurer, UPI is a liquidity machine.
Incredible. Okay, let's go to the smallest player, the MSME owner,
Right.
the microenterprise.
This person lives on razor-thin margins, maybe 5%. Accepting a credit card meant paying a 1.5% commission, which would gut their profit, so they stuck to cash.
Which is risky and leaves no paper trail.
Exactly. But when they could offer free payment acceptance through UPI, suddenly they had a perfect, instant digital audit trail of their entire business.
And that audit trail is the key to everything else.
It's immediate formalization. For the first time, a bank could see their real revenue. And that data let that owner get their very first bank loan to expand. They were lifted out of the informal cash economy.
So if you put this all together, the CFO scorecard is pretty undeniable. It's MDR, 1-2% for cards versus 0, And settlement speed, 2 days versus real time.
Yeah, and the sources show that for a, say, 100 crore rupee company, the total annual benefit from lower fees, no cash handling, no float, can be around 6 crore.
6% of revenue. That's not a cost center, that's a balance sheet engine.
Absolutely. It improves working capital by 10–15% and can boost EBITDA margins by 50 to 75 basis points just from fixing payments.
So we've seen the scale inside India, but now this is becoming a global story, an export. What is the lesson for the rest of the world here?
The lesson is that UPI is an exportable model. It's a blueprint for public financial infrastructure. Yeah. And we're seeing this pattern emerge globally.
Where?
Countries that treat payments like a utility scale the fastest. PIX in Brazil is a perfect example. Even FedNow in the U.S. is following a similar public model.
And that stands in stark contrast to the private monopolistic models that have high costs and create those proprietary walls.
Exactly. India proved that neutral rails, built by a nonprofit with zero merchant fees, can work at a scale nobody thought was possible. And now that template is being copied or linked to everywhere. Nepal, Sri Lanka, even in Europe. France is a big adopter.
And it all comes back to that human outcome. It comes back to Ria and her mom.
It does. The victory is societal. It's 300 million new digital users. It's formalizing the small business sector.
It's giving Ria's mom a seamless ping instead of the stress of not having the right change.
It gives dignity. It's an empowerment tool.
So let's synthesize this. Our deep dive shows 3 things. UPI is a public utility, not a business. 2, it saves companies serious money by crushing inefficiencies. And 3, it is now the leading global blueprint for this kind of infrastructure.
And that blueprint is already looking to the future. The forecast is for 1 billion transactions a day by 2027. By 2030, the vision is for UPI to be the backbone for programmable money for central bank digital currency.
Next evolution.
Right. But the final provocative thought for you, the listener, the policymaker, the observer, is this.
Okay.
India, a nation of 1.4 billion people, proved that payments can be instant, borderless, and free for the merchant at scale. So the question isn't whether this model will influence global finance.
The question is, why hasn't your country built this yet?